Hi, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. We'll just quickly run around the room here for who we've got on the call. We've got Salih Yilmaz, Senior Analyst based in Dubai, joining us today. Circling over here to London behind my shoulder here, we've got Will Hares and Patricio Alvarez, and over in 731 Lexington in New York, we've got Fernando Valle. So should be a fun discussion. I am just looking at the screen, seeing a lot of red today. Just Brent looks like it's approaching $72 a barrel and change, down year to date. My guess is that we've heard a lot of conversation about lower realized pricing for some of the companies in 1Q, but I want to get the readout from each of you and get a sense of where the companies think we could go for the remainder of the year. So Will, we'll start with you. You've had a few of the major energy companies report at this point. What have you heard so far based on the first bit of the year?
Yeah, thanks, Rob. So we've had BP, Total Energies, and Eni reports so far for 1Q, and what we've seen is pretty uniform trends emerging, which is big beats on earnings and in line to slightly beating on cash flow. The big driver here has been the trading units of these companies, which have delivered, very strong to exceptional in some cases gas trading and very strong oil trading profits as well. So this has helped offset some of that softer price realizations that we've seen easing through the first quarter. Now, what I would call this is low quality beats. These are not necessarily repeatable, and particularly against a further easing backdrop into 2Q, with much lower middle distillate margins and further easing gas prices in Europe and oil, as you just mentioned, Rob. We think the near-term outlook is probably softer for these companies unless their trading desks can surprise to the upside again. And also, we are seeing this translating into easing up of the buyback paces that were off to a very strong start in 1Q. One of the big headlines from BP's results yesterday was a sharp deceleration in their buyback pace to 1.75 billion in 2Q from 2.75 in 1Q on an expected lower surplus cash flow for the year. So we think that could we could see similar story out of Shell, which reports tomorrow.
Will, I know this is probably beyond the level of disclosure, perhaps beyond the level of discussion, but what does the beat in the trading businesses amount to for BP? Is essentially they got the call on the trajectory of the gas price, right, and the trajectory of the oil price as well, perhaps?
So it's not just the direction of oil and gas price movements, but it's driving optimization across their portfolios and price arbitrage. So particularly for a company like Shell or BP or Total with very large LNG trading businesses, they can exploit price arbitrages across their global supply portfolio. So that's a big part of the reason as well. Now, troublingly, the reporting and disclosure around their trading businesses is very limited, and this has been a constant thorn in the side of the street going back for a while now. But also on the flip side, these companies aren't exactly helping themselves with the lack of disclosure, as it's very difficult to value the trading business for these companies when there's such limited data to go off and transparency.
Yeah, okay, that sounds very interesting. Fernando, let's do the read across into the US. Are you hearing a similar set of themes, or is the narrative a bit different over there?
Slightly different, mostly because the balance sheets are in better shape to begin with, and they've made more investments that enable them to keep the buybacks going throughout the year, despite lower oil prices. So when you look at Chevron and Exxon, there were beats as well. They don't disclose any trading revenues on their side. They don't have discrete trading departments, but the most of their beat actually came from the refining side, where the margin capture was significantly higher than expected. Chevron actually missed slightly on the estimates, especially on the cash flow estimates, because of their international downstream. They're very exposed to Asia Pacific. We're seeing a slowdown in those margins, very distinct slowdown over there. So in the same vein as Will was saying for the Europeans, second quarter looks a lot more challenging. The good news is, even for Exxon in particular, even with slower margins, they more than cover both their capex, dividends, and buybacks. They generated over $11 billion in operating cash flow, and they distribute around $8.1 billion, including their buybacks. So you can see that even with a slowdown, they're still in a good spot to continue covering buybacks. And then you have the outliers. The refiners have been doing pretty well. Valero reported great numbers. Phillips this morning also with really good numbers. Marathon yesterday. Very interesting on the Valero side, saying that they are seeing double-digit improvements on their gasoline and diesel volumes across their system. And it goes very counterintuitive to what we're seeing on the other side of the equation. There have been some signs that gasoline is down about 3% versus 2021 on gas stations from a recent study from OPEC. We've seen decreases in travel bookings for the summer, which would also impact gasoline demand. And then if you listen to any freight forwarding company and their comments on the outlook, UPS saying down 10%, JB Hunt says we were in a freight recession. So all of those will impact diesel consumption, and the EIA numbers, which are admittedly noisy, they are also showing weakness. So we tend to side more against Valero on this one and say there is a slowdown going, but so far the earnings for all the three major refineries have been pretty positive.
Fernando, is this mainly the leading indicators on kind of macroeconomic slowdown that you see, and do you have any observations about markets outside the U.S., or are we seeing any kind of similar headwinds on the demand front?
Yeah, absolutely. And I think the macro side, as you said, a couple signs: the lower travel bookings, and then airlines also cutting down some of their schedules, and freight. I mean, that should be your biggest canary in the coal mine sort of warning, because we're ordering less. And even if you look at Amazon's earnings, their product revenues fell significantly, so there are fewer orders on that end. And then as far as other countries, Brazil started off pretty strongly on the fuel side of the equation. They had some currency appreciation that probably helped on their consumer side, but their interest rates remain very high. The equivalent of the Fed funds rate there, the Salih rate, is 13.75% per annum. So it's a very high hurdle for investments and for continued growth. We're seeing also issues at Petrobras with Lula trying to change how they both distribute dividends and they invest. Altogether, we think there is a slowdown there. They, again, boosted a little bit by the China reopening, but perhaps not as much as was expected.
Maybe just to add a little bit of commentary from the solar space, in phase grew its top line 65% in 1Q, First Solar 49% in 1Q, SunPower out this morning 26%. I would say largely, even though these numbers are sort of stratospheric compared with a lot of things in the traditional energy business, they were largely seen as a disappointment almost. I think the expectation was that they were going to perhaps do a little bit better and guide for better results. So fast growing business, but even there, a lot of worry worry and concern about some of the more macro headwinds. Salih, let's come around to you. Perched there in the Middle East, is it a similar perspective there? What are you seeing in your crystal ball based on what you've heard from 1Q here?
Yeah, I mean, pretty similar, I think. The only thing I would add is, I mean, in my world, the companies Repsol and OMV already reported in the last week, and we have Aramco reporting next week. And the chemicals business is to varying extent is important for these companies. And what we're seeing there is the kind of the faded GDP growth estimates and softer consumer demand is really weighing on chemicals margins. For Repsol, it's not a huge segment, but for OMV, after its acquisition of Borealis, and for Aramco, after its 70% stake acquisition of SABIC, chemicals are actually quite important for their group profitability. I think looking at 1Q, Repsol actually just slightly missed, even though their operational metrics were pretty good, so the miss was a little bit of a surprise. But then on OMV, it was a slight beat, but as Will said, it wasn't. I mean, it was due to things that are very unlikely to be repeated. I think more importantly, what they said about the rest of the year, their guidance for the year about, I mean, refining margins being very good in the first quarter, but then the expectation is very much that they will go down towards the end of the year, and just chemicals margins probably going to be even softer than where they were in the first quarter. I think for Aramco, one thing to note is because of the defensive OPEC plus stance and the voluntary cuts that they're bringing, I mean, obviously, Saudi Arabia being the largest producer in OPEC, them promising to cut 500,000 barrels per day starting this month means subdued production level for Aramco. So it's not just that they might be realizing lower prices. They're actually going to see their output level slightly below 10 million barrels per day, which is going to limit their upstream segment contribution. But the idea there is, I mean, we haven't quite seen the positive oil price reaction that perhaps a lot of analysts were expecting. I mean, we did see it, but then it's kind of faded with the renewed recession concerns and perhaps the U.S. banking turmoil effect. As you said, Brent being below $73 a barrel now, WTI being below $70 dollars per barrel now. I think they had a pretty decent 1Q, but the rest of the year, I think consensus is already reflecting that it is not going to be as strong as 2022, and the quarters are probably going to be softer than 1Q as well.
Okay, Patricio, let's bring you into the conversation. I think you had Ørsted out this morning, but generally, what are you hearing from the utility segment?
Yeah, so we just started the earnings season, so we only had a couple names reporting. But if I can just silo into two groups, I think the main theme for the vertically integrated companies such as Iberdrola and Enel, which reports later on today, has been a de-risking of the balance sheets. So these companies are actively looking to rotate their capital outside of, let's say, higher risk profile countries. For example, with Iberdrola's landmark exit from Mexico, that's one thing to flag, and an increased capital allocation bias towards networks as well. So these companies are investing increasingly into networks. In the case of Enel, we perhaps is one of the most interesting stories out there, and we'll be keeping a close eye out today, as the company is going through the process of selling roughly 13 billion worth of assets this year, basically just recycling capital out of Latin America and try and repurpose their investments towards Europe, mainly Italy. And the play there, or let's say the balancing act there, will be we expect obviously softer power price realizations, because wholesale prices have declined in line with gas prices, which are at their lowest point in almost 2 years. So it's a balancing act between sort of seeing the softer side on the cyclical exposure, but also having lower procurement costs on the trading side, which should allow them to unlock margin capture on higher power power price hedges that they captured during last year, if that makes sense. So it's all about retail, a recovery in retail margins, and boosting their defensive profiles by investing more into networks. And now moving on to, let's say, the second silo, which is independent power producers and renewable developers. Ørsted remains the barometer, I think, for the offshore wind industry. And today we saw results that were rather mixed. I think that's a good way of qualifying them. We saw them decline. EBITDA declined over 12% year over year, and that's mainly due to a decline in gas prices. So Ørsted, believe it or not, benefited quite a bit from the run up in gas prices because it owns combined heat plants and also the trading unit, which I think is a feature that also something that featured in Will's companies as well. Strong trading that's beginning to fade now in the first quarter as gas storage was mark to market. That was severe, like a lot weaker this quarter versus last. So we see now the evidence in the offshore wind, so that's the core segment of the company did improve, but it's mainly the non-recurrence of losses versus last year, and the pipeline. Let's say the development pipeline has not been de-risked further. So that means that we're not seeing a lot of capacity additions in the near term. We only have 2 relatively modest catalysts this year on offshore wind for Ørsted. Which brings attention towards the Capital Markets Day in June 18th, I think, June 8th, sorry, because we do expect to see a reshuffle because we do see persistent delays in offshore wind, and perhaps the company may need to pivot to onshore wind and solar, sort of to try and retain that above peer return profile that Ørsted has.
Okay, very interesting. Maybe it would be good to spend a little bit of time talking about the broad commodity complex here for a few moments, because I think that ties into everyone's franchise. Last year, we heard so much discussion about inflation, and now maybe the discussion seems to be switching a lot more towards kind of the macro views on demand. But oil is down year to date. Polysilicon, natural gas, the BCOM index, the broad commodity complex seems to have moved lower. And I mean, I think we've had a little bit of discussion here on kind of why the various commodities may be moving. But Salih, I want to come to you first. Obviously, OPEC Plus wants it to go in a different direction. Why are they having difficulty getting the price into the range of where they want it to be?
I mean, I think it's the panic in the market that they're probably finding very difficult to control. I mean, what we're seeing this week is a lot like what we saw mid-March with the initial US banking turmoil, where it's not very fundamental driven, it's very panic driven. So fundamentally, I think most would agree that physical markets are still, I mean, even though demand may be weakening just a little bit, physical market remains relatively tight. The Brent curve is backward dated, but it's just the expectation that the recession may be around the corner, that there might be from the US banking turmoil, there might be more pain to come that would translate into even weaker demand. So it's those expectations that are really weighing on oil prices. And I mean, what can OPEC do? I mean, they don't really change their strategy every day, but I think they've proven that they can change it every month. So I think what they did last time was they saw this panic potentially leading to an even bigger slide in oil prices. And given this is once again very similar to what happened mid-March, I personally expect OPEC to potentially announce even more cuts in the next month or so. I think that there is now a real possibility, because what they want to do is they really want to avoid a slump in prices similar to 2008. And the difference, I think, is that they've shown their defensive stance. They've shown that, they want fundamentals to be in the spotlight, and clearly they want. There is a hypothetical price floor that they seem to be wanting to protect. So Yeah, I think this is very panic-driven. It is very difficult to tell how all of this macroeconomic developments would translate into lower demand and how big the impact would be. It's very difficult to tell right now, but I think usually what happens, how the market reacts to situations like this, is just sellers back in control, and the slide in prices follow.
Okay, I want to come to Fernando next, because we have iterated on this call on the idea that lower now potentially sets the case for higher prices in the long run, given potential mismatch between supply and demand on our read of the fundamentals. Fernando, where are you at in sort of your thinking on the market right now? Are you cautious? Do you still see that long-term potential out there? What's your read?
Yeah, I think not much changed. I agreed with Salih that OPEC will be more prone to make changes, but I think fighting the Fed is a bad strategy. And we just had non-farm payrolls today up significantly versus expectations, and this is right before the Fed meeting. So we could see new hikes, more attempts at controlling inflation, and into what, as we mentioned before, is already a weakening economic activity scenario. I think China is certainly disappointed a little bit, not significantly, but a little bit on the tune of their reopening. They went through some destocking as opposed to just bumping up imports to 2019 levels. That hasn't happened yet. And then it is a bit of a new economy. I was just reading today, subway ridership in New York is only at 70% of 2019 levels. In San Francisco, it's under 50%. Obviously, there are dynamics in each city that make that the case, but it's a different world. It's a different scenario, and then you're trying to go against the 800-pound gorilla in the room, which is the Fed, trying to curb demand. I think the only driver in the short term will be that impact in trying to curb inflation and reduce frothiness in the market. And as much as OPEC has a lot of arrows in its quiver, they're not enough to take down the Fed. They'll probably continue to push. And then in the long term, I think there's a total misconception on energy security and energy transition. I mean, we've seen today plans that the U.S. will be half of the U.S. generation will be renewables by 2030. And if it's half the capacity, how much of the generation is it? 4%, 3%? We were replacing 1 gigawatt of nuclear with 1 gigawatt of solar, which means we are still net short on molecules. So it needs to be addressed, and I think I saw another interesting tidbit, which was just the challenges in decarbonizing trucking, for example. One single fueling of a truck, an ICE truck, gets you 1,200 miles of range in 15 minutes, as opposed to an EV truck, which gets you between 140 and 300 miles for a charge of about 10 hours. So obviously, very significant discrepancy there, and they cost 2 to 3 times more. The estimate was that it would cost $1 trillion to shift all of the trucks in the U.S. into EVs, and with obviously the operating costs being significantly higher.
I'll react to that just a little bit. A couple of really interesting stats is one that, right or wrong, maybe it's the wrong outcome, but solar, I think, was 50% of capacity additions last year. And if you look at the project pipeline, I think it's going to be more than that this year. So the freight train seems to be leaving in terms of what type of capacity is getting added. But I think you're very right to point out that there's a big mismatch between capacity and generation, and 1 gigawatt of solar is certainly not equivalent to 1 gigawatt of nuclear or many of the other generation options. One of the things that I heard this morning on SunPower's call that I thought was interesting, and this is a point they keep hitting home about, though, is that because of the elevated fossil fuel prices that have kind of been sticky in the utility rates, that actually helps to increase the economic value of a residential customer or a utility customer coming out and putting on solar, because the tariffs rose in response to all sorts of things. And I think the U.S. residential rate is, it's close to 15 cents a kilowatt hour right now, which is quite high. It's only 10 cents a kilowatt hour just looking back a few years ago. So these higher rates actually help people rationally maybe want to put solar on their roof, even if it doesn't really solve all of the sort of load balancing intermittency problems that you've got to think of if you're managing the full system. So, but with that, I want to come back around to Will Hares. Will, very interesting comments from Fernando on this sort of balance between energy transition and energy security. And just before the call, I was flicking through BP's latest release and trying to get a sense, has their tone changed kind of and how they're talking about energy transition, because it's been a big theme of theirs. But what's your read on kind of how the energy transition narrative is unfolding right now? Is it still full steam ahead? Is there a bit more reticence? And how's the commodity cycle play into it?
Yeah, so BP is an interesting case study for this question, because they obviously revised their strategy at 4Q results to much fanfare, where they eased their energy transition strategy pace. Now, the important part here is that I think a lot of the street viewed this as a slowing of their transition spending, which they actually aren't doing. It was just an increase in their oil and gas spending. So I'm firmly of the view that these companies are on paper slowing their transition pace, but in reality they're full steam ahead still. Their renewable power capacity targets are intact. Their spending remains as a share of total capex remains the same. And in BP's case, they were just sort of correcting their trajectory, which previously was the fastest of all of their energy major peers, as they were targeting a 40% drop in their production volumes by 2030. Now they're targeting a more manageable 25%. And of course, this is received quite positively by the market, because it will obviously translate into higher returns and likely higher distributions for shareholders. So long story short, I'm firmly of the belief that energy transition is still a runaway train for these European majors. It's just you might see a dialing back up of near to midterm spending on some high priority oil and gas projects as a result.
Okay, Patricio, I want to bring you into the energy transition discussion. Obviously, many of your companies are front and center there, and you were just at a conference, I think, last week or week before last, talking about the European energy transition, and particularly, I think there was some interesting commentary on offshore wind. So, tell us what you're hearing and what your outlook is on that front.
Sure. I think a key takeaway from the offshore wind conference is that permitting continues to be a major hurdle in Europe as a whole. I think the overarching complaint there from the sector is that some of the permitting issues circling around environmental permitting are not addressed prior to auctioning of a lot of the projects, and sometimes that means that project can take after you've been awarded a project, it can take up to 3 or 4 years for you to actually start laying on the power lines and start the construction of an offshore wind farm. So that takes a process that should be, construction of an offshore wind farm should be anywhere from 2 to 5 years. It takes it all the way up to almost 10 years. That's not on average. This is just based on empirical sort of ad hoc projects. So don't take this as a rule of thumb, but I think that was the key highlight. And it's just also looking at ways in how the EU Commission can effectively respond to what the U.S. is doing with the Inflation Reduction Act. I think it was no one missed that discussion that the incentives to invest in the U.S. are far more transparent and provide visibility for the next 10 years without of all these sort of bureaucratic hurdles, I'd say, and the access to the funds is quite direct. So I think the needle has turned now. A lot of the earnings calls from the European utilities that invest in offshore and onshore wind have now turned increasingly towards questioning their expansion plans in the U.S. Because I think while the policy support in the European side of things is still very strong, I think to declutter the permitting bottlenecks will take at least a couple of years. The EU Net Zero Industrial Act seems to address these things or targets these types of problems, but it doesn't seem like there's a sort of a light at the end of the tunnel and anytime soon. I think it will take at least a couple of years for these things to get resolved.
Okay, that's very interesting. We've got a couple of questions in the chat. I don't think we'll have time to get to all of them, but I will go ahead and take the first one because I think it's relevant and we haven't touched on it yet. So the question is on the SPR in the US and thoughts on the strategy and question of whether we will ever restock. Fernando, you're probably closest to that, but we'll get views from others. Fernando, you first, though.
Sure. So it was an anticipation of sales, so technically it doesn't need to be restocked anytime soon. It's at the discretion of Congress and the DOE. The DOE had signaled that they wanted to buy under 68, and WTI is at 69 right now, so it could be. The EIA numbers just got released, and we actually saw another drop in the SPR, which again are mandatory sales, as opposed to a strategic decision. So I think as at the current status, we could probably see some refilling. I would expect it to take several years for us to do all the 200+ million barrels that we emptied in the past year. It will probably take 3 to 4 years, if not more, and of lower oil prices. I don't expect it will be a sudden impact. 1 million barrels a day will probably be much smaller, and the DOE really has to come together and create a very clear strategy on how they will repurchase. The swaps didn't work out very well, so I expect they'll be back with oil prices at these levels.
Is there any sense that they could use financial contracts to lock in the sort of refill at the current price, or
they're not allowed to?
Interesting. Okay, Salih, any particular different read from you on that?
Not at all. I mean, I think the guidance last I checked was to refill it at a price range for WTI of between $67 to $72 a barrel, I think. And I mean, we already have seen WTI prices in that range. So eventually, I mean, if they remain there, I agree with Fernando that, you know, I think they would start refilling. But as Fernando mentioned in previous calls, I think logistically it's also not that straightforward. So it would not be overnight. It would actually take years, even if we were at price points where they are ready to refill it. It just would take years to bring it back to the levels that we saw a couple of years ago.
Very fascinating discussion. I think we're going to have to leave it there. We'll be respectful of everyone's time. We're already a few minutes over. We always blow through half an hour, and I feel like there's plenty more that we could have discussed here on the call. So if you're unaware, we hold these on the first and third Wednesday of every month. Make sure to join us next time. We'll continue the discussion. If you have any follow-up questions, we're happy to chat with you. Just shoot us an IB and we can expand on any of these topics. And if you're not in our client chat, we'd encourage you to join any of us, we can help get you added. So I hope everyone has a great rest of their week, and I look forward to talking to you the Wednesday after next. Take care.